the idea, I mean, everybody's praying for lower interest rates because so much of the private sector is zombified. Without lower interest rates, government debt traps are being sprung. We need to get lower interest rates. But the reality of the situation is that interest rates are not about managing the economy. They're about reflecting the loss of purchasing power of a currency. So that's going to continue. And at the same time, because banks are trying to de-risk their balance sheets because they're very highly leveraged, what they're doing is they're raising rates against anyone who wants to borrow. That is assuming that they can be persuaded actually to extend any credit. It's not a question of gold rising, it's a question of fiat currencies led by the dollar falling. And this is really why the central banks in Asia, and particularly the People's Bank of China, have been selling dollars. What do they sell dollars for? Euro? No way. Yen? No way. Sterling? No. In other words, they're selling for real money, which has no counterparty risk, and they recognize that as gold. I think we've got to make a distinction between bonds, equities, and bank deposits, if you like. Bond yields are going to rise along the yield curve, and with debt traps, do not be surprised to see bond yields go way over 10%. Which is more than double the current level. How long it will take for that to happen, I don't know. But I had experience of this in the 1970s in the UK. And it was an experience of which Americans faced too in that decade, particularly towards the end of the decade. So that's the first thing. The second thing is that if you're looking at equities, they take their value from two things: the availability of credit generally, and also the cost of that credit. Now, the cost of the credit gives you, if you like, that sort of is determined in investment terms very much by what the bonds yield. So if you've got rising bond yields, then that is going to destroy the valuation of equities. And the availability of credit, that's going to be contracting as well. So one way and another, I would expect a very severe bear market in equities. I would not be surprised to see equities lose over 70% of their value from current levels. I'm not making investment recommendations. This is just how I see things. When it comes to bank accounts, it is a primary responsibility of the central banks to ensure that the commercial banking system, and you'll see with what's happened with Silicon Valley Bank and so on and so forth, that they have been rescued or deals have been arranged to ensure that deposit holders are protected from insolvency. That is a process which will continue. Now, it is an open question as to how that will be managed in a widespread problem. I mean, if, let us say, we imported a problem from another jurisdiction, for example, rising bond yields in Japan, how that might undermine the GSIB banks, or indeed a similar situation occurring in the Eurozone with the Eurozone GSIB. US banks, incidentally, about 13.5 times leverage. So that gives you a rough idea of the difference. The dangers from abroad cannot be ignored to the global banking system. What we're looking at, I think, potentially is something which is far more difficult for the authorities to manage than the great financial crisis, which led to the Lehman failure, and those moments of sort of thinking that the whole system is going to collapse from underneath us. This is considerably more difficult.
To understand the importance of gold and silver, we need to first examine the current state of bonds, equities, and bank deposits. Bond yields are set to rise significantly, possibly exceeding 10%, which is more than double the current levels. Reflecting on my experience from the 1970s in the UK, and a similar scenario faced by Americans during that decade, such an increase is not unprecedented. This historical context provides valuable insights into what might unfold. When considering equities, their value is largely derived from two factors: the availability of credit and the cost of that credit. As bond yields rise, the cost of credit increases, leading to a decline in equity valuations. The availability of credit is also contracting, signaling a severe bear market for equities. A 70% drop in equity values from current levels is not out of the question. On the topic of bank deposits, central banks have a primary responsibility to safeguard the commercial banking system. We've seen this in action with the rescue of institutions like Silicon Valley Bank. However, managing widespread problems remains an open question. For instance, rising bond yields in Japan could undermine their banks, and similar issues could arise in the Eurozone. With U.S. banks operating at around 13.5 times leverage, the dangers from abroad cannot be ignored. The global banking system is facing challenges far more complex than those seen during the Great Financial Crisis. This time, it's not just about gold rising, but fiat currencies, led by the dollar, falling. This scenario has prompted central banks in Asia, particularly the People's Bank of China, to sell dollars and accumulate gold. They're not just buying gold, they're offloading dollars, recognizing gold as real money with no counterparty risk. Central banks in Asia and other regions are acutely aware of the precarious state of Western currencies and the governments that issue them. These governments are trapped in debt, and this predicament is driving central banks to shift their reserves into more stable assets, like gold. As of now, the exchange rate is hovering around 61.35 to the dollar, nearing new lows. This decline is expected to continue. While the Bank of Japan is contemplating slight interest rate increases, significant hikes are unlikely. The U.S., with a debt-to-GDP ratio of approximately 130%, faces a similar situation. Foreigners, particularly the People's Bank of China, are selling dollars, further exacerbating the funding problem. Japanese institutions are also selling dollars due to losses on their U.S. Treasury investments. This complex interplay of factors is creating a significant funding issue. The Federal Reserve's response to this situation is constrained. Lowering interest rates is not a viable option. They must keep rates high to maintain the carry trade, where investors borrow yen, sell it, buy dollars, and benefit from a substantial yield differential. This arrangement defers the U.S.'s funding problem, but highlights the distortions in the global financial system. Amid these distortions, there's a growing chorus for lower interest rates. However, the reality is that interest rates reflect the loss of purchasing power of a currency, not just economic management. Banks, facing high leverage, are raising borrowing rates and tightening credit. This tightening will progressively push businesses into worse financial conditions, leading to insolvency and bankruptcy. In this volatile environment, the value of gold and silver becomes evident. Unlike fiat currencies, gold and silver are tangible assets with intrinsic value. They are not subject to the same risks as paper, money, or digital currencies, which can be manipulated by central banks and governments. Gold and silver have historically been safe havens during times of economic uncertainty. They act as a hedge against inflation and currency devaluation. As we witness the erosion of purchasing power in major currencies like the dollar, the euro, and the yen, the stability of gold and silver becomes increasingly attractive. Central banks, particularly in Asia, recognize this and are adjusting their reserves accordingly. The People's Bank of China, for instance, has been a significant buyer of gold. This trend is a clear signal of the shifting trust from fiat currencies to tangible assets. Let's take a moment to highlight some expert opinions and external sources to reinforce our discussion. Renowned investor Ray Dalio has frequently emphasized the importance of diversification and the role of gold in a balanced portfolio. In one of his recent tweets, Dalio stated, "Gold is a timeless and universal storehold of wealth. When you don't own gold, you know neither history nor economics."
It's not a question of gold rising, it's a question of fiat currencies led by the dollar falling. This is really why the central banks in Asia, and particularly the People's Bank of China, have been selling dollars. What do they sell dollars for? Euro? No way. Yen? No way. Sterling? No. In other words, they're selling for real money, which has no counterparty risk, and they recognize that as gold. And so this is why everybody thinks they're buying gold, but in fact what they're doing is selling dollars. The conditions that are worrying the People's Bank and various other, particularly Asian central banks, is that they can see what's going on with these Western currencies. They're fiat currencies, and the governments that issue them, or their central banks, but certainly the governments that are responsible for these currencies, are in debt traps. As I look at it at the moment, as we're talking, it's 161.35 to the dollar, almost a new low, matching last week's low point, and that is going to go lower. Why? Because while the Bank of Japan is talking about, looking at the interest rate situation and maybe raising them a little bit, I mean, they're not going to raise them really. If there is any change in monetary policy, they'll probably raise it by 0.25% or something like that. And of course, there's the good old USA, with a debt to GDP of about 130%, and foreigners selling the dollars, as I just said, particularly the People's Bank selling dollars. You've got the Japanese institutions selling dollars as well because they've got losses on their bond investments in US treasuries. So one way and another, there is a funding problem. So what does the Fed do about it? Lower interest rates? No, it's got to keep them up because it needs people to borrow yen, sell the yen, buy dollars, and pick up the carry trade. I mean, the carry trade at the moment is giving you a nice sort of 5% plus turn. As long as that continues, then it defers the funding problem of the good old US of A. So you can see that all is not well in the world. It's all very, very distorted. The idea, I mean, everybody's praying for lower interest rates because so much of the private sector is zombified. Without lower interest rates, government debt traps are being sprung. We need to get lower interest rates. But the reality of the situation is that interest rates are not about managing the economy. They're about reflecting the loss of purchasing power of a currency. So that's going to continue. And at the same time, because banks are trying to de-risk their balance sheets because they're very highly leveraged, what they're doing is they're raising rates against anyone who wants to borrow. That is assuming that they can be persuaded actually to extend any credit. So the idea that this is a time when interest rates should be falling and all the rest of it, I mean, I'm sure the banks hope that the central banks can muscle rates down because they've got loans out to customers who are basically zombies, and their business plans are just completely shot at these levels of interest rates because nobody expected them to come up here. But so that DK is a slow burning fuse, which means that businesses are going to just go progressively into worse and worse financial conditions, with them becoming insolvent and going bankrupt.
To provide a broader perspective, let's consider some external insights. Renowned investor Ray Dalio has frequently emphasized the importance of diversification and the role of gold in a balanced portfolio. In one of his recent tweets, Dalio stated, "Gold is a timeless and universal storehold of wealth. When you don't own gold, you know neither history nor economics." Moreover, a recent article in the Financial Times highlighted the increasing central bank purchases of gold, describing it as a global shift towards financial security. This shift underscores the growing consensus on the importance of gold in mitigating financial risk. Another noteworthy point comes from Lynette Zhang, who often discusses the systemic risks in the financial system. She argues that the current debt levels and leverage are unsustainable, making gold and silver indispensable for long-term financial security. One particularly interesting perspective comes from a recent interview with Jim Rickards, a well-known economist and investment banker. Rickards highlights the strategic moves by Russia and China to accumulate gold as a means of hedging against the decline of the US dollar. He states, "These countries are not just preparing for a rainy day. They're preparing for a complete overhaul of the global monetary system." Given this comprehensive analysis, what practical steps should investors take to protect their wealth? First and foremost, consider diversifying your portfolio to include a significant allocation to precious metals like gold and silver. These assets provide a hedge against the devaluation of fiat currencies and offer stability during economic downturns. Additionally, keep a close eye on the moves of central banks and large financial institutions. Their actions can provide valuable insights into the broader economic trends. For example, the continued accumulation of gold by central banks suggests a lack of confidence in the long-term stability of fiat currencies. It's also essential to stay informed about geopolitical developments. Political instability and economic policies in major economies can have significant impacts on the value of currencies and precious metals. For instance, the recent tensions between the US and China over trade and technology have added to the economic uncertainty, further highlighting the importance of holding tangible assets like gold and silver. Finally, consider consulting with a financial advisor who specializes in precious metals. They can provide tailored advice based on your individual financial situation and goals. Remember, while gold and silver are valuable assets, they should be part of a diversified investment strategy that balances risk and reward. In conclusion, as we navigate through these challenging times, understanding the value of gold and silver is crucial. These precious metals offer stability and security that fiat currencies cannot match. By diversifying into gold and silver, individuals and institutions can protect their wealth from the inherent risks of the current financial system. Remember, this isn't just about the price of gold rising. It's about the declining trust in fiat currencies. As central banks worldwide adjust their strategies, It's clear that gold and silver are becoming central to financial security. For our American viewers and allies, it's essential to recognize that the current financial strategies of central banks and governments may not always align with individual financial security. Diversifying your assets and considering investments in gold and silver can provide a buffer against potential economic instability. As we face uncertain times, ensuring your financial future with tangible assets is a prudent move. Stay informed, stay secure, and remember the lessons of history as you navigate the path ahead. In these turbulent times, it's crucial to stay vigilant and proactive in managing your wealth. By incorporating gold and silver into your investment strategy, you can create a more resilient financial future for yourself and your loved ones.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.